Today we're going to be talking about 3 fundamental principles of personal finance that I believe will lead to a better understanding of how your money can work for you. My name is Josh. Welcome to Your Financiation. You probably can't tell from watching, but I'm pretty excited to be covering an actual topic today. Today's video will lead to a wide range of other videos that I'll be covering later this month and in months to follow. I want to first talk about a concept that isn't necessarily one of the 3 principles I'll be covering, but it's just as important. I mentioned it in the introduction video, that it's something I'll be coming back to, but what I'm talking about is discipline. Discipline to me is one of the most important factors in determining how efficiently you can build your wealth. The reason why discipline is so important is because it requires work and dedication. If you can commit yourself to those 2 things, you're going to be on a fast track to reaching your financial goals. It's not easy. Staying dedicated to your financial goals is one of the most difficult things that any person can take on, because there are so many temptations out there to spend on things you don't need. It's a consumer culture, and we're kind of taught from an early age to just buy. But I'm talking about just regular people like us that can do better for themselves if they just stay dedicated to bettering their financial health. And that's one of the things that I'm trying to do with these videos, is just to help people think smarter about their money. The first principle I'm going to talk about in this video is cash flow. So cash flow is simply the combination of income and expenses. It's typically tracked on a monthly basis, and the goal is to spend less than you earn. If you spend less than you earn, that makes for positive cash flow. There can be positive and negative cash flow. Now, if you're spending more than you earn, obviously that's negative cash flow. You're probably getting yourself into some kind of debt doing that, but you want to focus on the positive cash flow. Hopefully, you're keeping track of your finances month to month, but if you're not, that's okay. I'm going to be covering it in the next video, budgeting and saving. But after you've tracked how much you've spent on the necessities, things like rent, utilities, bills, groceries, things like that, you want to think critically about what you're going to do with the money you have left over. Now, the 3 basic options are: you're either going to spend it, you're going to save it, or you're going to invest it. So the first thing I'm going to talk about is spending it. Now, believe it or not, there are smart things that you can spend your money on. And I'm not talking about, if you get a bonus, being able to go to Chili's 1 extra time this month, so you can splurge on some margaritas. I'm talking about spending on an unwanted debt. Debt comes with interest, and interest is just such a crutch in your ability to save or invest. And those 2 things are your quickest way to building wealth. Let's talk about saving it. When it comes to saving, there's one important thing most people don't have, and that's an emergency fund. Having an emergency fund is such a stress reliever, especially when something bad happens that you don't expect. I know the typical recommendations is 3 to 6 months. Unfortunately for myself, I don't have that much saved up, which is terrible, but I'm on my way to getting there. I'd say to start with building up 1 month's worth of necessary expenses, things like rent, the things I mentioned before: rent, utilities, groceries, anything else that you spend on that you absolutely need. Work on saving that in a separate savings account, and having that extra money there will be such a stress reliever in terms of being ready for that next emergency that you have to pay for. The last thing I want to talk about in terms of the 3 basic options of what you can do with your cash is investing it. If you want to get started with investing, that's great. If you're still in debt, or if you don't have an emergency fund built up, I'd focus on those 2 things first. But it doesn't hurt to at least get your feet wet in investing and I think starting in the first week of February, I will be releasing the first video on a series of Investing 101 videos. So that'll be extremely helpful in terms of starting to build your understanding and knowledge of what it means to invest, what risks are associated with investments, and investment types, what risks are associated with those investment types. So the second principle I want to cover is the time value of money and this idea of opportunity cost. Money now is worth more than the same amount of money in the future. And I'll be getting into an example on the next slide. The goal is to start investing as early as possible. And that's just because of the amount of interest that accrues on your investments. And so later on down the line, you'll have a much larger pool of wealth that you can draw from than if you started investing later in life. If you're not educating yourself on investing, then it could be something that you're just totally blocking yourself off from. And that's not something that you want to be doing, especially if you want to reduce the amount of stress related to your finances. And let's get into the example. So there's a formula for calculating what the future value of your money is. And it's represented here by this formula. The future value is equal to the present value of your money multiplied by 1 plus the average interest rate you earn on your investment to the power of the total years you're going to be invested. So let's say we're investing $100 for 10 years into the S&P 500 index. Now the S&P 500 index is just a basket of companies, America's 500 largest publicly traded companies, and it's typically a benchmark for tracking the stock market. So when the financial media talk about how well or how bad the market's doing, they're typically referring to this S&P 500 index. And I'll be covering how you can invest into these 500 companies in a future video. So the average stock market return is about 10%, and the average ranges from 8% to 12%. Now year to year, that number can swing pretty wildly. We had some years like 2008 during the Great Financial Crisis where it was down like 30 or 40%. And this is just taking into account all the years averaged out into a smaller range. So I want to be conservative in this example, and I'm going to use 8%. So let's take a look. So I wrote out the formula again just for your convenience, but you can see that I've filled in the numbers with what values are given in this example. So let's say we're starting out with $100 and we're multiplying that by 1 plus the interest rate, which is 8%, represented in decimal form is 0.08, and we're investing it for 10 years. So we're giving the 1.08 a power of 10, and what that comes out to is 2.16. So 100 times 2.16 is $216. With this example, I wanted to show that if you're investing at least $100, then 10 years from now, the value of that money is going to be $216. So you can see that given the choice between getting $100 now and investing it or getting $100 10 years from now, taking the option of $100 now would give you $216 10 years from now rather than $100. So that's where that idea comes from of the time value of money. And opportunity cost is just the cost of choosing the option of $100 10 years from now. You're missing out on $116 over the 10 years that you could have received if you had invested $100 now. You're going to see a lot of things online about getting rich quick, 10xing your money. There's so many clickbait videos on YouTube. Oftentimes, what they're going to tell you is that it doesn't exist. If you do end up tripling your money or, like 10xing your money in crypto, it's extremely lucky. It's not prudent investing. and it's not something I'm going to recommend on this channel. I won't be posting clickbait videos like that because I want you guys to have the truth. I want you guys to understand that building wealth takes time, it takes work, and it takes dedication. And the third principle I want to talk about is risk requires reward. Now, the goal is to understand that different investment types carry varying investment risks. The first thing that I want to talk about with risk is risk tolerance. Now, risk tolerance is just the amount of risk that you're willing to take. If you take on more risk, you're generally going to have a higher potential for a greater reward, but it's not always guaranteed. We're going to take a look at the types of risk, and I'll talk about the different types that you'll be exposed to when you invest in the markets. And the more you learn about the different types of risk, the more empowered you'll be to make a confident decision of what investment you want to make. And the last thing we'll talk about in that separate video is reducing risk and ways you can reduce it. So that concludes my presentation on the fundamental principles of personal finance. I hope you enjoyed the content. Let me know if you have any suggestions. I'm totally open to anything you want to add onto it. I can do a quick follow-up video on any extra things you guys want to hear or anything that you want me to go more in detail with, and I can certainly do that. Just let me know, like and subscribe, and stay tuned for the next video. Thanks.